Hello, everybody. Welcome to our live Blue Belt Financial Skills and Investments. Thank you for joining us once again. Hope you're having a great weekend. If you like to just type in where you're joining us from. If you have any questions, you can just type in the comment section. Or if you have any comments that you think may actually be helpful to other viewers, you can also type in. Today, again, we are joined with Themba. Themba is a chartered accountant with more than 24 years of experience in corporate financial management and risk management. He holds a master's in business administration and has been a consultant and trainer in areas of risk management, asset and liability management, and investment management. Today, Themba joins us as an upcoming author of his book, Manage Your Personal Finances Like a Black Belt. And Themba believes that if someone is in a number of streams of income, they can achieve their financial independence within 5 years. And he also believes that for one to attain their black belt status in personal financial management, they have to have had financial skills, the right mindset, a developed level of consciousness, and developed habits. Benjamin Franklin also says, an investment in knowledge pays the best interest. So we really appreciate you, Themba, for your contribution and your coaching and all the knowledge that you're sharing with us. And we don't take it for granted. Thank you very much. Over to you.
Thank you very much, tafadzwa, for that very kind introduction. It's been a time since we've been on this coaching journey. And today we want to specifically talk about investment 101. The reason why we've titled today's presentation Investment 101 is because we want to introduce you to investment. There are certain things that I want to address in this presentation, and I will talk about some of those things. One of the things that I've heard people talking about is that putting money in shares or investing in shares is like gambling. You know, there's some people who think that investment is like gambling. They equate investment to gambling. That's one of the things that I want to deal with today, that there is a world of difference between investing and gambling, right? World of difference. I've also heard people saying, I am putting my money in the bank and therefore I'm investing. If you are putting your money in the bank, you are not investing, you're probably saving, right? So there is a world of difference again between investing and saving. And those are some of the things that we would want to clarify in this particular, presentation. Investing starts with a plan. I will not take you seriously as an investor if you do not have a plan. One of the things that I will try to mention today is that don't be in a rush to invest in products and buy shares, bonds, property, if you haven't finalized your plan. What comes before investing is a credible plan, which is why we've been talking about this financial independence, plan. It's also very important to note that the more financial education you get, the more likely you're going to be a successful investor. So I'm going to persuade you today to be somebody who lives and breathes investing. Repeat after me. I am an investor. I am a skilled investor. I am a master investor. The more financial education you get, the more you're going to be good at it over time. Before we go into today's presentation, I always advise my coaching clients to have an investment mentor or hero whose philosophy they subscribe to. In my investment journey, I have gotten to study a character called Warren Buffett. Warren Buffett is probably one of the most successful investors of our generation. And his investment philosophy, forms the way I've built my portfolio over time. So what I would advise you to do is to read about books of somebody whose investment philosophy you like, somebody who is a guru in investing. And there are many such, characters. Warren Buffett himself, he had his mentor, who has been, a stock market guru, the person that I referred to in my last presentation. The other advice that I would want to give you as you embark on your investment journey is that when you get hold of a newspaper, try to go through the business part of the newspaper. Try to spend your time listening to financial news. You'll be so amazed that many people spend their time, reading things that do not necessarily contribute to their financial independence. I advise my coaching clients to spend their time consuming material that contributes to their financial independence goal. What's the point of following all the gossip in town and knowing who is doing what? How will that help you at all? So that's one of the advices that I will have for you in this investment 101 masterclass. The other advice that I will try to give you is that don't invest based on a tip from your neighbor. There are some people who will give us tips, and some of them are very well, they are well-meaning when they give us investment advice. It could be in a church, it could be at work, and somebody says to you, cryptocurrencies are the in thing today. Go and invest in cryptocurrency. And then you go and invest in those things. When it comes to investment, it's all about research. It's all about your own risk appetite, because we've got different risk appetites. So before you even embark on an investment journey, make sure you've got a plan. Make sure you have educated yourself about different asset classes that we'll talk about. But more importantly, as individuals, the way we are made is that God has wired us differently. Some people, through the wiring that they got, from God, are risk takers by nature. Other people avoid risk. And then there are individuals who are risk neutral. So it's very important as an investor to know your risk appetite. The risk appetite, the importance of a risk appetite is that it defines the boundaries within which you are going to execute your investment strategy. You're not going to buy each and every other thing. There are people who have made money, but they have got a high investment appetite, which you probably do not have. If you were to invest in the kind of things that they invest in, you would be having sleepless nights and you would be having a heart attack. And that's the thing. I was reading last week about the Facebook founder. I think in the last month, he has lost, probably more than 100 billion because Facebook as a stock has come tumbling down. If it was probably you would probably be having a heart attack to say, look, my portfolio is going down. But he is an entrepreneur. He is probably not worried about it. In fact, in his last presentation to the analyst community, he pleaded for patience. He said, we know what we are doing as Facebook. We've got a plan. We've got this and that. Obviously, the market did not immediately buy into his story, but I believe in the guy. I believe in, Zuckerberg. He's an investor. By the way, he's a very young man. And so he can afford to have all that volatility in his, portfolio. That's why some of the financial advisors that you will meet there, they will tell you, if you are young, take more risk. As you grow old, take less risk. I don't believe in that advice myself. What I believe in is that we've got different investment appetite. There are some people who are comfortable with volatility, with wild swings in their portfolio. There are other people who are not comfortable with that kind of volatility, and therefore they would go for safety most of the time. So it becomes very, very important to know how you are wired. So those are the things that we'll be talking about, today. For those of you who have been following me, we've been talking about a belt system. So we spoke all the way from the white belt. Now we are on the blue belt before we go to the brown belt. And eventually we are going to be black belts in terms of managing our finances. I did emphasize the last time that at blue belt level, we are concerned, number one, with making sure that you are able to create your own financial independence plan. My financial independence plan was such that I wanted to be financially independent in 5 years. I wanted to get rid of all debt that I had. And I've been able to do that. And that's what gives me the confidence to be able to present the material that I'm presenting to you today. You probably know my stance by now. If you've got debt, please do not start on this investment journey before you settle your own unproductive debt. So if you've got credit cards, if you've got clothing accounts, if you've got, microfinance loans, I do not advise you to start on this investment journey until you have settled all your debts. That's why at the green belt level, I think we started even at the yellow belt level by teaching people to come out of debt. I sometimes hear people saying to me, Themba, I've got additional funds and I have to make a decision between settling my bond and buying shares. If you do not have enough financial education, you are better off settling your bonds. Trust me, you are better off settling your loans, very quickly, because there is some kind of volatility associated with investment. And the way investment works is that the more financial education you have, the more you become confident when it comes to investing. By the way, today, I'm not just lecturing for the purposes of lecturing. I would want you to commit to 5 actions that I will present at the end of this presentation. We do action-oriented coaching. We would want people who take action. There's some people who are very good at, saying amen, Themba, to what you are saying, but they don't really take action. In the last part of the presentation today, there are 5 things that I would want you to commit to, which constitutes your action plan after this presentation, because that's very, very important. So by the time we get to blue belt level, we've gotten rid of unproductive debt. We are living below our means. We know how to negotiate because we've spoken about that. We know how to balance our budget. We are tithing. I've introduced you to the concept of tithing. We are separating at least 10% of our income towards investing. So that is the commitment that you have made by the time you get to blue belt level. Over time, as we explained, you are going to increase that percentage of 10% to a higher amount, because that's very important. So at blue belt level, we are concerned with, number one, making sure that you are competent enough to create a financial independence plan. Number two, that you are comfortable with the concept of investing, and that at that stage, you have opened an investment account. I'm not talking about a bank account. Banking, putting money in the bank is not investing. I'm talking about probably opening a share trading account. That's what I'm talking about. Let me just be clear to you. In my view, I believe that the easiest way to introduce somebody to investing is to make them buy shares. Shares are what I call a plain vanilla investment product. By vanilla, I'm just talking about simplicity. Sometimes in the world of finance, we use the word vanilla to just, talk about simplicity. So in finance, whenever we talk about vanilla products, just know that we're talking about a simple product. So in this class, we will talk about plain vanilla products. By plain vanilla investment products, I'm talking about shares, I'm talking about bonds, I'm talking about property, I'm talking even about cash, because there are certain, times in the economic cycle where you might need to put a certain percentage of your investments in cash because all the other asset classes are probably losing you money. So investment is volatile. There is some volatility associated with investment. Oh, by the way, people who have been investing since the beginning of this year, some of them have been crying because if I look at what has happened to the JSE All Share Index, it's lost quite a bit. I think we are even, close to 20% down than we were at the beginning of the year. So there is some kind of volatility that is associated with investment. But what distinguishes the investors from the speculators is that investors are in for the long term, for the long haul. So one of the things about investing, I will talk about two things about investing, which I would want us to be mindful of at all times. The first thing about investing is that investors aim to beat inflation. So investors have got an objective. In fact, what characterizes the discipline of investing is being able to have an investment return after costs, after taxes, which is higher than inflation. That's one of your enemies when it comes to investing. So we really need to understand that because that's very, very important. The other thing that characterizes an investor is that an investor has got a long-term outlook of things. So just as a simple rule, you are not an investor until you are committed to parting with your money for at least 5 years. Right. So investing has got to do, and that's what distinguishes investing from speculation. Investors have got a long time horizon. They are not worried about month-to-month fluctuations in share prices, in even yearly fluctuations in share prices, because over the long term, they are going to make money. So that's what we'll be talking about. Some of you might be very, curious. What will we be talking about at the brown belt level? At the brown belt level, we then teach you to create different streams of income. Here we're talking about passive income. So blue belt level, we've done our financial independence plan. We've been able to create at least one source of passive income. We've taken action in terms of investing in a plain vanilla investment product, such as a share, such as bonds, and so forth and so forth. Then at the brown belt level, we then do other things. At that stage, I will introduce you to the concept of entrepreneurship. By the way, the most successful of investors understand businesses and they start their own businesses. I have grown to understand over a long time that the best investment returns that I have achieved in my own life were in my own businesses. If you invest in somebody's business, you will get a return, but sometimes that return is not as high as you will get in your own business. The reason is very simple. In your own business, you've got control, and control is a very important driver of returns. That's why investors try to have as much control as possible. Some of you might be following what is happening in the business news these days. You might be aware that Elon Musk acquired Twitter, and he wants to take Twitter private. so that he can create a more valuable asset out of it. One of the things that we need to learn from that is that if Elon Musk had just taken an equity stake in Twitter, which did not constitute control, he would not have been able to do all the things that he wants to, to do with the Twitter. So control in investing is very, very essential. Let's just go into the content of today. There are 4 things that I want to talk about. I want to just make it clear to us what investing is. There is a difference between investing and saving. There is a difference between investing and speculation. So in the first section, I'll take 5 minutes to explain what investing is. Secondly, I will then talk about the principles of investing. I would want to talk about 9 such principles. Some of them I've been talking about, over time, but I want to just reiterate those principles. Then I want to introduce you to different asset classes. The asset classes that I'm going to talk about today are plain vanilla asset classes. Remember, the word vanilla means simple products. Later on, when we go to brown belt level, I will introduce you to more advanced investment products. You probably might have heard people talking about derivatives. You probably might have heard people talking about cryptocurrencies and alternative investments such as private equity and what have you. Those are some of the products that we'll talk about at the brown belt level. In Investment 101, we just talk about the plain, vanilla investment products. Then after that, we're going to look at our action plan. So what is investing? Investing is, number 1, committing money, committing time, and committing energy to your own plan for a future benefit. What is the future benefit? The future benefit is the generation of passive income. So that's what investment is. If you are not willing to commit money, sorry, you can't be on this investment journey with me. I need for you to commit at least 10% of your income towards building an asset base. So there must be a commitment of money. There must be a commitment of time, right? That's why I said to you, you need to be attending such classes like the one that I'm giving now, or you might even opt to reading my book. You might even opt to reading newspapers, business newspapers. You might even opt to listening to business news. For example, my favorite show is, the 702, show by Bruce Whitfield at 6 p.m. I make sure that even if I miss that show, I play the podcast. I'm also, listening to the CNN Business Report, which comes later on. So I tune into that business report to just have an indication of what's happening. What is happening to the markets? Where is the world going? How do I need to position my portfolio? So the thing about investing is you must commit time, you must commit energy for a future benefit, right? That's what investing is. As you do that, you must be aware of enemies of investment. There are things that will try to bring you down as far as investing is concerned. Let's just call them, for simplicity's sake, enemies of investing. Your number 1 enemy is inflation. I do not have time to tell you about, what has happened in Zimbabwe in terms of the economy and the hyperinflation that the economy has experienced. The thing about inflation is that it makes investing very, very difficult. Remember, you have to have an investment which is higher than inflation. If inflation is in Zimbabwe's, scarce at the moment around 200% or even more, where will you find an investment product that will give you that kind of return? Because your return has to be higher than inflation. And so an inflationary environment poses a huge challenge to investing. And that's the thing, about it. Not that there are no strategies of operating in an inflationary environment. There are strategies that I can share with you of people creating money in an inflationary environment. So let me give you one such strategy. You can't keep your money in what we call monetary assets. You have to keep your money in non-monetary assets like property, like things. If you are in an inflationary environment and you keep your money in monetary assets, then you're losing value. It's just that simple. If you are in an inflationary environment and you lending money to people, then you are transferring value to whoever is borrowing money from you. So the reason why I'm mentioning that is that you probably may be aware that the world is in an inflationary environment at the moment. In the United States, they are talking about inflation of, north of 8%. They haven't had such inflation in their whole, in a long time. In South Africa, our inflation is slightly less. In the EU, they are also talking about inflation. So inflation, whenever you hear that the world is going through high inflation, just know that your investments are being threatened. In other words, the buying power of your money, the purchasing power of your money is reducing. So inflation is an enemy of investing. Number one, costs. The reason why I'm talking about costs is because before you invest in a product, particularly products that are sold by financial institutions, be mindful of what it costs you to invest in that product. Because sometimes we just look at the return that they are promising, but forget that they have to subtract their own costs. So costs are a very, very, important enemy to investing that we need to consider. I also come across people who want to be trading shares, who want to be trading currencies. The thing about trading is that for each trade that you do, you have to pay a certain amount of cost. So the more trading you are doing, the more you are actually being charged in terms of cost. So investors who are clued up, ask simple questions like, how much are you going to charge me for the trade? How much are you going to charge me for managing my money? Because all those costs eat into your investment return. And then taxes, right? So one of the things that we try to do in investing is to minimize, taxes as well. By the way, anybody can be an investor. Somebody think that it's only the economic, people with an economics background who can be an investor. I am a teacher. I am a handsman. I am a nurse. I don't have a background in finance. No. Investing is a discipline that we all can master, regardless of what our professional background is, regardless of where we come from, because investing is like farming. You plant a seed, you water the seed, it grows, and then you get something out of that. That's what investing is all about. It's just that simple. It's just that simple. So the thing about, if you are following my analogy of planting a seed, which is then watered until it grows, you then understand why I am talking about certain investment, principles. Principles like don't eat your seed. Because if you eat your seed, you'd rather spend time eating the harvest, right? But the seeds you never, because the seeds must be planted for you to benefit from the harvest, right? But on slide number 6, I just wanted to emphasize the point that the purpose of investing is to beat inflation. Why is it powerful for us to be investors? If I look at an employee trades time for money, right? You will get money, but that's a painful way of living, because you're trading money. You're trading your time for money. Investors are able to have time because their money is working for them. If you're just an employee who is not investing, you cannot have time, right? So the reason why I like to teach people about investing is that I hear people having lofty, goals, such as themba. I want to have time for my kids. I want to have time to do the work of God. I want to have time to travel, right? The easiest way in which you can achieve that is to be an investor, because employees do not have time, right? Business owners sometimes also do not have time. And investors, invest money, and that money works for them, and that money grows over time. That's why you will actually see that even for people like Bill Gates and some of the people like Warren Buffett, they start off as employees, they become business owners, and ultimately they become investors. Right? That's the journey that I have followed. I used to work for Absa Bank. Before then, I was working for KPMG. I then became a business owner. Now I am building an investment portfolio, because that's the only way. I'm being reminded now of a scripture in the Bible which says, a good man leaves an inheritance for his children. It's a verse in the Bible. How do you leave an investment if all your life you have been trading time for money? The only way you can do that is by being an investor. I don't care what you are investing in, just be an investor. That's the power of being an investor. There's a world of difference between savings and investing. If you are putting your money in the bank, you want to save for the short term, you are saving. You are not investing. If your money is in the bank, you will not beat inflation, right? Just to do a simple calculation for you, inflation in South Africa is currently just north of 7%. The return that you will get for putting your money in the bank will not be more than 3%. And therefore, if your money is in the bank, you're actually losing value. That's saving. Saving is very good. We must be savers. Savings, people who save normally have got a short-term objective. I've got a wedding, next year, and therefore I need to accumulate some money. That's very good, because the distinction between saving and investing has to do with time horizon. It has to do with the objective. With savings, you have got a short-term objective that you have. With investing, you've got a long-term objective. Remember I said, investors have got a time horizon of at least 5 years. Why are we talking about 5 years? Because it's been accepted in finance over time that an economic cycle is at least 5 years. Obviously, it's not true in all cases, but as you will appreciate, there are times when things are going well in an economy, and then there are times when we go through recession. For example, Europe is in all likelihood going to go through a recession. And one of the things that I was hearing the Christine Lagarde, I think she's the head of the Europe Central Bank. She was basically saying, we are going through a recession, we are raising interest rates, but even though we raise interest rates, it's not going to be necessarily a cure for inflation. Because what is happening at this time is that for a long time, central bankers thought that inflation that we are experiencing now was transitory. In other words, it was permanent, it was temporary. But now they are realizing that this inflation that we are experiencing is not transitory. It's actually sticky. It's here to stay. That's why you will see now that central bankers are raising interest rates, because that's probably the only tool that they have to control inflation, right? Remember, a central bank in a country is tasked with preserving the purchasing power of money. And they have got very limited instruments such as interest rates. So when they feel that inflation is going up, which it is at the moment, they then raise interest rates to control demand in an economy and money supply growth. And therefore, we are going through that period where to control the inflation, central bankers are raising interest rates. All right, it's just basic financial knowledge that you will get when you listen to news, when you read financial. There is a difference between investing and speculating. I've heard people saying, I'm investing in cryptocurrencies. I personally believe that cryptocurrencies will be a payment mechanism for the future. Have you heard? I think Pick and Pay announced 2 weeks ago that they will be accepting cryptocurrencies to buy groceries. I don't think it will make much difference, but I think there are people who are beginning to appreciate that cryptocurrencies can be used as a payment mechanism, as a transaction. But is it an investment asset? Probably it is. I'm not convinced it is at the moment. Because the thing about an investment, a proper investment asset, is that you can value it. You can have a valuation model to value it. For example, shares. We can actually calculate the value of shares. And that value is supported by fundamentals. For example, the value of a share is supported by the earnings of the company. So if a company is making losses, its share price will come down. If a company is making profits and it's got growth prospects that we are excited about, then the share prices will increase. That's the fundamentals. So a share price is not something that is, it's not supported through a valuation model. We cannot say the same of, cryptocurrencies at the moment. That's so I'm not saying that if you invest in cryptocurrencies, you might not make money. You might make money, but you are speculating, right? It's speculation, right? Same thing, I've had people who buy paintings and say, Themba, I'll buy this painting. It's a very valuable painting, and then I will keep it for some time. It's a rare coin, and then I will then, sell it at some point. You can do that, right? But it's not an investment as such. An investment is, when we talk about an investment, we are talking about investing where we can calculate the value for it. Unless you are talking about a painting for which there is an established market and people can value, then those kind of payments can be an investment, right? But a speculation is where you are buying an asset whose value you cannot easily calculate, but somebody tells you this is the value of the asset, and then at some point in the future, you are waiting for somebody who is not as informed as you are, or who is just foolish to buy that asset from you. So that's speculating. That's speculating. People make money through speculating. You might have heard of a billionaire called George Soros. George Soros is a billionaire. He made his money as a speculator. So you can compare Warren Buffett on the other hand. Warren Buffett is the model for investing. He made his money through investing in assets that have gone up over a long period of time. So he invested in companies such as Coca-Cola. So Warren Buffett is a model for investing. George Soros is a model for speculation, right? For some of you, we have read about financial history. George Soros is the guy who nearly bankrupted the Bank of England because he speculated on the value of the pound at some point. And that's where he made, most of his money. So speculators do become billionaires as well. But the difference between investing and speculation is that investors have got a long-term horizon. Speculators have got a short-term horizon. The risk associated with investing is moderate. The risk associated with speculation is very high. If you have had people that end up committing suicide, they are probably speculators. There was a guy who used to be a great stockbroker, Jesse Livermore, in the 1920s. This guy could do nothing wrong. I think he ended up committing suicide because when the stock market crash came, right, he lost a lot of money, of his trades. And, because the thing is, speculators are normally aggressive. They make their money through short-term movements in the market. And they normally play with advanced instruments such as options, cryptocurrencies, foreign currencies. Whereas with investing, we normally focus on plain vanilla assets such as stock market, bonds, mutual funds. We are very cautious. We are conservative. Warren Buffett is one of the most conservative person that I have come across. I've grown to understand the Warren Buffett philosophy. His philosophy is that buy undervalued assets, and when they go up in value, you sell them. So when he buys stocks, he does a calculation, evaluation of those assets, and he buys undervalued assets, which he knows will go up in value. And that has been my philosophy over a number of years. I make my money from day one. I make my money from day one. I make sure, because anything can happen in the future. And so I do not buy overvalued assets. I calculate what the value of the asset is to me. Then that's what I offer. I think I told you one of the stupid mistakes that I have made in personal financial management was to offer a ridiculous amount for the first property that I bought in South Africa. And I thought that there were a number of bidders for this property, which I liked so much. The thing about investing, guys, is that investing is not an emotional thing. Don't bring your emotions to investing. Investing is about numbers. It's about buying undervalued assets. It's about being cautious and conservative. And investing is a sure thing, right? The risk in investing is moderate. Normally, when it comes to investing, we are fundamental, investors. There's a difference between a technical person and a fundamental, person. With fundamental investors, we look at the fundamentals of the investing. For example, when it comes to shares, the fundamentals of a share is the earnings that the share is producing. And so we calculate those earnings, we give a value to the share based on a realistic assessment of the earnings potential of that share. And that number that we come up with is what is normally referred in finance as the intrinsic value of a share, right? And then we look at the price of the share in the market. If the price of the share is lower than what we think is the intrinsic value of the share, we buy that share, because we know that over time the share price will correct. And when the share is overvalued and it's above our intrinsic value, we sell the share. That's what investing is all about. So if I will summarize, don't get lost in the language and in the terms that I'm using. The thing that I'm saying to you and communicating to you is that investing is a sure thing. It's not gambling. So speculation is more like gambling. So we are using the word speculation, but a more English, a more appropriate English term that we can use is the word gambler. So there are gamblers who make money through gambling, right? We have mastered the art. And I've given you an example of George Soros, if you know the guy. Those are speculators. So what are some of the principles of investing? Number one, preservation of capital is a priority. In investing, we don't lose money. We don't lose money. If it comes to a point that we are losing money, then we sell that investing, right? So the number one rule of investing is that preserve your capital. Preserve your capital. Never lose money. And there are two things that I want to say about that number one rule of investing. The first thing is you are more likely to preserve your capital if you buy undervalued assets than if you buy overvalued assets, right? So if I go back to the recent purchase that Elon Musk did of Twitter, I think he bought an overpriced asset there. It will be very difficult for him to create value out of that asset. So I know Elon Musk is a celebrated investor. I love the guy. I love his guts. I love his thinking. But if the truth were to be told, he bought an overpriced asset in Twitter. Warren Buffett probably would not have done, that kind of thing, because the thing about investing is you're worried about preserving your capital, right? The other thing that I want to say about rule number 1 is that I hear people who are saying they are investors, then they separate their money into investing. Then after a year, they have got immediate needs. They go and liquidate that investing. Don't do that. The thing about investing is that we are putting money away so that we create an asset base, so that in the future, we live off the dividends, the interest of our investment. It's like somebody who has got a cow, right? If you've got a cow, you can live off the milk of the cow. You're not going to slaughter your cow, because if you slaughter the cow, the next day you won't have any milk. So that's the philosophy that we have in investing. The cow represents your capital. The milk represents the dividends and the interest. So the cow represents the asset base. You need to take care of the cow, feed the cow, give it appropriate food. But the way you survive is from the milk of the cow and selling the milk and feeding off the milk. You don't survive from the meat. The meat of the cow represents the capital. And so when you are investing, that's capital. That's not what you live off. You live off the dividends. And so we need to preserve that capital and make sure. So if you are a dairy farmer, what you want to do is to have a number of these milk cows, because what you live off is the milk. And that's what we are doing here. So preservation of capital, making sure that the asset base is growing, is the number 1 rule of investing. Invest only in assets that potentially will meet your plan objectives. So don't be in a hurry to invest in shares if you are not sure whether that product is going to meet your investment return. So in investing, we are not fixated about the product. We are fixated about the plan. The plan will tell us what product we invest in, because that product will then meet our objective. The mistake that many people make in investing is that they are fixated with products. They don't have a plan, but they want to invest in property, they want to invest in crypto, they want to invest in all of those things. That will not work. It will not work at all. What will work is to have a plan. Then the plan will tell you which asset class to invest in, right? That's how we do it. Number 3, develop your own unique investment philosophy. When it comes to investing, we don't follow the crowd, because in most cases, the crowd is wrong. There are a lot of stupid people on the stock market, right? There are a lot of stupid people on the property market. And so when you go onto the stock market, when you go onto the property market, you are trying to make money from these stupid people who just follow everyone else, right? So we don't follow the crowd, because in investing, in all likelihood, the crowd is wrong. We do our own research. We educate ourselves. We calculate the intrinsic value of the shares. Then we've got a unique investment philosophy. I won't tell you today what my unique investment philosophy is, but I have developed a unique investment, system which guides my investment on the stock market. I don't just go onto the stock market and buy a share. That share is to meet my investment criteria. So here is the thing. Before you buy a share, before you buy a stock, you must have a written down investment criteria, which specifies what type of share is consistent with the plan objectives that you have. So that when you buy shares, you are not buying shares based on what your neighbor has said. You are buying shares based on an established investment criteria that you have had for yourself. That's what investment is all about. If you've got a dislike for numbers, If you are lazy to do research, you are likely not to be a very good investor. Because the thing about investment is to gather as much information, more information than the rest of the crowd have. And then based on that information, based on the research that you have, you can then achieve an investment return, right? That's what investing is all about. All right. I wanted to give you some of the Greek terms that we use in investment. For example, we use the term beta, right, to reflect risk. So whenever you hear people talking about beta in investment, they are basically talking about risk. I will introduce you to another term later on, just so that you are comfortable. Because if you go to a particular community, you have to speak their language, isn't it? Same thing when you come to the investment community. You have to speak the language. If you come to church, you have to speak the language of church people. If you come to the investment crowd, you have to speak their language. And so over time, I'll be introducing you to the language. I've already said, do not attach emotions to investments. So don't be emotional. If you make a mistake, I've made several investment mistakes. Live and breathe investment 24 hours a day. Diversification is one of the most important rules. In fact, I should have written that in red. The more diversified you are, the more you are likely to withstand the volatility in the market. I've already spoken about the other principles, so I will not repeat myself. Let's talk about the different asset classes. I want to introduce you to the different asset classes. I have extracted a graph. That graph is up to 2018. So don't worry about the numbers themselves. I just wanted to introduce you to some of the plain vanilla investment asset classes. So you can see that graph is a graph of some of the investment returns between 2008 and 2018. So it's a 10-year period, right? So you can see there that real estate has been number one. So real estate is an asset class. We are talking about property. So what it just tells you here is that if we look at 10-year returns of all plain vanilla asset classes in South Africa, property has outperformed, some of the, so which means I advise you to have some property in your portfolio. Then you will see there, apart from that, you've got there, bonds. Bonds is another asset class. Bonds is basically an instrument where either government, because in investment, all instruments issued by the government are the safest instrument. So the South African government can issue government bonds. They can issue a shorter term instrument, such as a treasury bill. And sometimes even as retail investors, we can invest in some of these things. So what are some of the asset classes that we have? Property, bonds, equity. Equity is basically a fancy word for shares. And then cash, right? So let me just, give you another graph. Again, going up to 2018. If you look at the 15-year return in South Africa, property has been number one, 16.8%. Shares number two, 15.3%. Foreign equity. These returns fluctuate. Even in 2021, things have fluctuated every year. These things, but it just gives you an idea of the plain vanilla. So cash, 7.5%. If you look at the average inflation over that time is 5.7, right? So I've introduced you now to 4 asset classes: property, shares, bonds, and cash. And even the shares themselves, they are then further divided into other asset classes. For example, if you are investing on the stock market, they are what we call large caps. Large caps would be basically your large companies that have got a huge capitalization. Then you've got your mid caps. Then you've got, I'll introduce you to all those categories. So the return that you get from large caps will be different sometimes from the return that you get from your mid caps and your smaller caps as well, right? So those are the asset classes. Today, it was all about introducing you to the asset classes. The last thing that I would want to do today is just for you to commit to 5 actions. Number 1, I want you to decide on your financial independence goals, right? When do you want to be financially independent? My goal was to do it in 5 years. What is your goal? Is it 5 years? Is it 10 years? The earlier you start, the better. I want you to decide on your risk appetite. Are you risk averse? Risk averse people are people who try to avoid risk. They are very cautious people. Are you very cautious? Then there are people who are indifferent to risk. Let's just call them risk neutral. Then there are people who are risk takers, like the Elon Musk of this world. They thrive on taking risk, like the Zuckerbergs of this world. But you are wired in a certain way, right? Some people have made an appetite and age thing where they've said old people have got a less risk appetite than young people. I don't believe in making appetite and age thing. You just have to know your appetite. For example, I'm a risk taker. I take risks, all right? Then number 3, decide on the asset classes. For me, if I were you, I would start with shares, all right? That's the starting point. Then you finalize your financial independence plan. Then I want us to be very practical about it. If you've got money in the bank, that's not an investment. I think I have already told you. So I would want you to open a share investment account. By the next time that we're going to have this presentation, you must have opened a share investment account. I've given 2 websites there that you can consider going on to: www.easyequities.co.za. I've got an Easy Equity account myself. Just go there. Some of these companies give you a demo account where you can actually simulate actual share trading, and you can have a feel of what it is to be in the market. I also have a PSG account, so you can go to PSG. There are many other. I've just given you ideas so that you can take action. So that's for it. That's what I wanted to say today. Tafi, thank you for the opportunity. Back to you.
Thank you very much for that presentation. I don't see any questions, but I've got 2 questions that just came up as you were presenting. The first question is maybe just clarity. How does one know their risk appetite? And can one be, maybe you spoke about age, where they say maybe when you're older, you're risk averse, and when you're younger, is there a possibility where maybe because of circumstances, you can be risk averse and the other time you're a risk taker? Is it like it's either or a person can be on the other extreme, maybe based on circumstances? Then the other question, the last question was, I think if I heard properly, you mentioned that the more you do transactions, the more charges, the more costs maybe you incur. How does one manage that? Do you have to maybe wait for a while, you accumulate the money so that you just do one big transaction? Or how can one manage that issue of incurring costs when doing transactions?
Thank you very much. So let's tackle the first question. Before I tackle the first question, let me make some things clear. Investing is not risky. So that's the first thing that I want us to say. Speculation is risky, right? Investing is not risky, right? Investing is not gambling. As long as I have communicated that message very, very clearly, then I've done my job today. The second thing that I want to communicate as a key message is that what will determine your risk appetite is basically your time that you would want to retire by. So let's just say, I want to retire in 50 years. If you want to retire in 50 years, you can do so by taking less risk. The only thing is that you don't know whether you'll still be alive in 50 years' time. If you want to retire to, next year, it's still possible. What it means is just you need to take more risk. So let's just, so risk, when it comes to what we have been talking about here is that your retirement goal determines the amount of risk that you may need to assume. In finance, we've got the equivalent of the law of gravity. Taffy, I'm sure you know that the law of gravity governs all the other motion that we have on Earth. In finance, we've got the equivalent of the law of gravity, and that's the law that says high risk, high return. Never forget that. So which means if you are aiming for a high return, you have to take more risk, right? That's why I advise you to be on the offensive and not on the defensive. So if you want to be more cautious, so forget about how you are wired. Let's just establish these principles. The more you would want to get from an investment, the more risk you need to take, right? The other thing that I want to establish as a principle before I directly address your question is that financial education and knowledge lowers that risk, right? So the more you are knowledgeable, the more you have researched, the lower the risk that you have, right? So we have established that number one, the shorter your retirement time horizon is, the more risk you have to take. We have established that investing is not risky, speculation is risky. We've also established that financial education and research lowers the risk, right? Once we have established those things, let's just answer your question. How do I know my risk appetite? All right. You know your risk appetite by your reactions. Say for example, Taffy, I say to you, I've given you money. I want you to grow this money. I've given you 100 rands. If you are the kind of person that says, I don't want to lose this 100 rands, otherwise I will have a heart attack. There are certain people who, if that 100 rands were to be lost and it is reduced to 5 rands, they cannot take it, right? They are not wired to have these fluctuations, because what is risk? Risk is volatility. That's what risk is. In finance, we define risk as volatility. In fact, the specific mathematical term that we use is standard deviation. So risk is standard deviation around the mean. It's volatility, wild swings. There are some people who, if I were to take you on a roller coaster ride, you would say, no, I don't. For example, if I were to ask you a question, Taffy, can you go with me bungee jumping? You would say, no, I don't want risk in my life. There are other people who would want risk. They actually welcome risk, right? So you have to look at yourself and say, am I a risk taker? Have you ever started a business before? Can you stomach wild fluctuations? Can you pioneer something? Can you capitalize on an opportunity? Or you prefer safety, right? For example, there are people who, for their life, they want a job, they want security, right? Because, risk-averse people are interested in security. They do not want to take risk. So I will give you a checklist which I will post next week with some of the standard questions that financial planners will just use to say, am I a risk taker, am I risk averse, and so forth and so forth. And then we can look at those those factors. But broadly speaking, risk is volatility. Some people cannot stomach volatility. They want to be safe. They don't want anything that deviates from the usual or from the ordinary. So if you're like the kind of person who does not want deviation, you want a secure job, you don't want anything that upsets. If you hear that there is no money today, then you go very crazy. Then you are risk averse. You try to avoid the risk, right? You just want peace of mind. Then there are people who, even if there is nothing today, they know that tomorrow can be a good day, right? Those are some of the people that are risk-taking. Your second question was around costs and trading costs. The principle there is that buy undervalued assets, wait for them to go up in value. So the principle of investing is that do your research. This is a standard Warren Buffett principle. Do your research. Don't be trading in and out. Normally in investing, we buy undervalued assets. We wait them, for them to grow. Normally, I look at my portfolio after 6 months. And, after 6 months, if there is an underperforming share, then I may decide to sell. Imagine if you're that kind of person who every week you are buying and selling, then the transaction cost will be too much, for you. So there is no standard period that we can say, don't trade, but the thing about investing is that we make our money on day one. We make the right decision on day one to minimize the risk. The reason why we do that is that we don't want to minimize the risk. That's why investing is very different from gambling, because in gambling, you don't do your research, you just go in there, and if it feels like it's not doing very well, you then exit that position. Because if you do that, you will end up incurring significant costs.
Thank you very much for that comprehensive response, and thank you for the session today. I personally have benefited a lot, and I will definitely act on the action points. For those who want to get hold of Themba, you can visit his website, www.duplexinstitute.com, or you can subscribe to his YouTube account, Manage Your Personal Finances Like a Black Belt. You can also visit our website, www.tafadzwa.speaks.co.za. And thank you for joining us. We appreciate your support. Enjoy the rest of the weekend. Cheers.